Hello, this is Jan Kotze, also known as Bear Bully. So we're going to launch a series of videos now that explore and test and really pit different algorithms against each other to really ensure that when we get into an algo, it deserves a portion of our money to be traded with. Many providers really focus heavily on marketing when their algos have had a winning streak. And then often these strategies mean revert after your purchase, which was because of the marketing efforts of the provider. And it's quite disheartening when the algo then really underperforms or mean reverts and you not only paid good money for it, but also then lose money to the market as a result of the algo. So today we're going to look at profit algos that has really got a package of algos, but one of his algos that I really like is the DAX 5-minute. And specifically, something about it is the fact that it tries to avoid funding costs. Since after COVID, when interest rates have gone up a lot, funding has become a significant burden for algo traders. And it really eats into the performance of the algorithm. Now, you have to be made aware that when you backtest algos, in platforms like this Pro Real Time, it doesn't take into account funding costs. That sits completely outside of these results. And if you're not aware of it, you are actually flying a little bit blind because one algo versus another algo could spend so much more time in the market, therefore paying away so much more of its returns to funding costs. So a second step will be needed to really be able to compare one algo to another. This algo, however, by and large, avoids funding costs. So we're going to look at this one first. To evaluate this algo and to evaluate all of the algos, we are going to use a measure called the Calmar Ratio. The Calmar Ratio um, basically expresses return in terms of the drawdown that this algo at its worst experienced. Drawdown would be the minimum investment that you would have needed to survive whatever money this algo would have lost. So it can also be seen as the capital that you would have needed, probably plus additional margin to take the next trade thereafter. But in essence, it is the capital that you would have needed to run the algo. Um, now, profit is not the only metric that we should look at when we are assessing algos. So it's important to see the profit together with the risk that the algo introduced for you, right? Now, the Calmar ratio does that all in one, and the calculation is gain divided by drawdown. So in this instance, let's just focus on the original DAX 5M our results from ProfitAlgos. We see that it returned $13,000 and it had a drawdown of $1,380. So that calculates a Calmar ratio of 9.59. In the industry, anything above 3 Calmar ratio is considered excellent. So This is really in a different league, coming in at 9.59. It is excellent. Um, the other metrics that we can look at for this algo, just to really uh, understand it fully, is the average gain per trade. Now, for algo that has got excellent metrics like it has, 12.57 is actually quite low. I normally go for algos that are running at about $40, $50 per trade, on average, would be the result. Now, we need to understand why this is so low, and the reason is exactly to avoid the funding cost. So the algo is closing trades once a day just before the funding window arrives, and then it reopens it straight after. So it it's increasing the volume of trades that we are looking at. That gets divided into the gain, and then therefore we get a lower average gain per trade. So it's not really a deal breaker, because we know on top of this, we are going to get something between, depending on where overnight interest rates are now, plus the 2.5% funding charge that IG adds on top of that. You're already adding another, say, 5 to 6%, depending on the country you're trading from and what your interest rates are, to the yield of this algo. Now, one thing I do for a quick and dirty calculation of yield is I go and look at the the price that the first trade, the back test, has taken, and then I make that amount the equity of the back test. In this case, it was, if I remember right, it was about $13,000 or something. Just see over here, $15,000 something, and so we can now see two things. From the statistics over here, we see an annualized rate of return based on that starting capital of 22.51%. And intuitively, if our overnight funding rates were, let's say, 5% at its worst, plus the 2.5% of IG, you you're still beating that with a very wide margin. Um, so it's worth running this algo based on that yield factor as well. Lastly, by setting the equity equal to the first trade, you can therefore also see, just by looking at the equity curve and its final result, which we've got here as 29,020, and you can do a direct comparison to the value of the index as it is right now, 25,322. And we can immediately see that this algo is actually outperforming the DAX index itself. So that gives us another piece of information, and that is that uh, relative to the start and the capital that we deployed at the start of this algo to now, there is actually now 4,000, roughly 4,000 additional dollars in our account that we could choose to either withdraw if you want to keep things the same as in the beginning, or you can say, I'm going to start to increase my position sizes to also utilize this additional equity that has been generated. Um, and then you get additional compounding or compounded returns to what you are already receiving Note I'm saying already receiving because the growth in the DAX also contains a compounding of returns. And by keeping your position size at the same amount from the beginning to now, you are therefore indirectly also investing in such a way that you are enjoying compounded returns. But you can now actually get additional compounded returns from the additional capital that you've created. So, what else? Basically, we're saying this is a great algo, probably the first one you should try. And then I want to address something for the Australian community. You may not know, but when you trade a DAX instrument and you choose to trade it with an Aussie dollar denominator, your funding costs will be determined at a different time than the European sessions or the instruments that's exposed to European currencies. Now for Australia, that is 10 to 5 in the afternoon, our time, which is about, well, it's basically between 8 and 10 hours earlier than the DAX. All right. So the DAX funding window is 11 p.m. The Australian one will be, let's say, at this very moment, it's 10 hours earlier. So you're looking at about um, when it's about 6, 7 o'clock in the morning for the DAX. So in order for the Australians to also get the benefit of not having to pay funding costs on this algo, we had to introduce code into the algo that shifts that closing of the trades a little bit earlier. So let's have a look at what results, how that impacted on the statistics of the algorithm. This is this little table here on the left. I'm just moving closer and you can see a slightly higher gain, 14,073 on 1193 trades, so more trades than the original, and the yield was 23.68%, so a little bit of a better yield. Now there's a couple of things that happened here. Number one, when at that time when the Australian funding window arrives and we close the trade, the DAX only trades with a bid offer spread of 5. So I'm saving 2 points on the bid offer spread as to when the European funding window arrives, when the DAX trades at a spread of 7. And one other thing is the reason the Australian one takes more trades is because on a Friday I have to close my trade twice. I have to close for the funding window and then again at 11 p.m. So that would help me avoid the weekend interest, and compared to the European algo, it only closes once on a Friday. But regardless of all of that, it's worth doing because we also now can enhance our yield by another 5 or 6%. Or I think at the moment Australian rates are about 4%, so plus the other 2.5, and that's significant. So it's worth doing. So all up, really a good algo because of its Calmar ratios. Unfortunately, the Australian one here, and it's something I'll look into as to why. You see over here in this period from August to September, it had a significant underperformance compared to the original, and it would be worth exploring why that happened. But that really pull down the drawdown here and that compared to this original. And that really then reduced the Calmar ratio of this version of the algo to about 6, 5.99 to be exact. So still very good, but it could have been better. Um, right, well, it's quite exciting to really have this opportunity to go through algos and help you guys understand what to look at and which algos to go for or which algos to give your money to. Um, and I'm really excited about the ones that are presented by ProfitAlgos, given that many of them have got exceptional Calmar ratios. Not all of them avoid interest because it would kill their edge, but they do well on their own merits, so worth looking into. So I'm looking forward to cover off the next algo for you, and see you again soon. Thank you.